Welcome to Magnifi Plus, where we help you invest with intelligence, meaning that with Magnifi, you can now do more than just trade stocks. You can search, you can discover, you can invest in the ideas and the values that are most important to you using our revolutionary machine learning software. I'm Nicole Lapin, former CNN, CNBC, and Bloomberg anchor, and your host for today. Joining us today is Holly Newman Kroft, Managing Director, Senior Wealth Advisor, Neuberger Berman Private Wealth. Holly has been a wealth advisor for 17 years and oversees $3.5 billion in assets. She is the #2 female financial advisor in the United States and has been on the top of Barron's list for the last decade. Holly, welcome. It is such a pleasure to have you here.
Thank you. It's great to be here, Nicole.
We always watch you on CNBC. You're awesome, very astute insight. We got to ask you for your trajectory in your career. Obviously, women are underrepresented. Can you tell us a little bit more about how you got to the top of all the lists for wealth managers?
Sure. I mean, I think women are underrepresented generally on Wall Street. And actually, and maybe interestingly, I did not start my career on Wall Street in wealth management. I started in investment banking. And I worked as an investment banker for about 10 years, where women are perhaps even less represented. I took stock of my life 10 years into my career and recognized that while I wanted to work and wanted to build a successful career on Wall Street, that was very hard to do in investment banking. So I switched then from corporate finance to personal finance. And I found on this side of the business, you can build a successful career, be very dedicated to your clients and building a book of business, and still have time on the side to be a full-time mom, a great wife, and have 2 full-time successful careers, perhaps.
Why do you think women are so underrepresented?
I think this is a problem in the world. Perhaps it's more prominent on Wall Street, but women have to make choices. Families have to make choices, and oftentimes they will choose a spouse's career that is more profitable. There's still a huge wage gap in this country between men and women. Women earn about 80 cents for every dollar men earn. So if you are choosing one spouse to pursue a more profitable career, it's more often than not the man. I think women feel pressure, whether it's internal pressure or social pressure to be present and available for their families as well. And that's often a conflict when you're a full-time working mom. So I think it's really important as a woman especially, but also for men, to think about what are your goals in life? What do you want to accomplish, and what is the best way to do that? Be realistic in planning your future so that you can have success in every aspect that you want to.
You know, Holly, a recent Magnifi survey said that women are 40% less likely to invest than men, 30% more likely to cite things like lack of knowledge or lack of confidence as leading reasons for not investing. Do you have any advice for female investors who are just starting out and might not have as much confidence?
You know, that's an interesting question, because I think your survey is exactly right. Women are much less confident in investing, whether they're just starting out or they're well into their career or their life. Overconfidence is predominant among men in this space, and women often feel threatened, or they think that the questions that they might ask are stupid. And what my job is to educate people and help them to understand what they're investing in. And my best advice to people is, wealth is a responsibility, and it's your responsibility. And if you don't look after your own money, no one is going to do it for you. So it's crucial to work with someone who you feel comfortable asking any question and who's willing to teach you in a way that you feel good, you feel comfortable, and you feel that your goals can be met.
Okay, so let's teach us, if you can, talk a little bit about the markets. Interest rates have had their biggest move up in the shortest period of time ever. Stocks were down last year. Are the people you're talking to scared?
I mean, look, volatility breeds uncertainty, and in a down market like we had last year certainly creates some jitters and perhaps a couple of sleepless nights. What's really important is to identify a client's long-term goals and make sure that their risk profile and their risk tolerance is being met and reflected through their investments. I think what we learned through the great financial crisis in 2008 and 2009 is perhaps one's asset allocation, which is a reflection of their risk tolerance, is maybe even more important than the investments that they make within that asset allocation.
So given that the clients you're talking to are cautious or long-term in nature, how do you best protect them now given these market conditions?
So the way we invest clients, it's always is with a view to their long-term goals and how to generate returns on an after-tax risk-adjusted basis. Today, with, as you mentioned, interest rates have risen incredibly quickly, we can invest in very attractive fixed income securities with a high yield and sit on the sidelines and wait for the volatility to settle down in the equity markets. In the previous decade, when interest rates were at or close to zero, we had to really stretch for returns and stretch for yield. And by doing so, we had to take more risk in a client's portfolio. And different clients have different risk profiles. Older clients might be more conservative, younger clients might be more aggressive simply because they have a longer time period to invest. But for all clients today, we can take a little bit of risk off the table and take advantage of the higher interest rates.
When you sit down with the client for the first time, how do you determine their overall asset allocation? What are some of the questions to determine what that should be?
So asset allocation is directly tied to one's risk tolerance. So I ask a lot of questions. What are your goals for the money? What is your time horizon? Do you need income off of this money? Do you plan to buy a house? You know, what are all of the components of your financial well-being that you can share with me so that I can put together an investment portfolio for you that will meet your needs and protect you on the downside?
And how do you figure out what your risk tolerance is? If someone's investing for the first time, they're like, so I like to skydive. I don't know. Are those correlated to how your risk would be going into equity markets for the first time?
I mean, I don't know if skydiving is directly correlated to risk taking in the markets, but that's a good point. It might be. My goal really is for clients to sleep at night. So if they say to me, I'm a new investor, I'm a young professional, I don't intend to touch this money until I retire, I'm not going to look at it every day, I just want it to grow. That's a riskier profile for a client. Whereas if someone says to me, when the stock market declines 10%, I throw up and I can't sleep at night. I say my job is to let you sleep at night and build your portfolio with the reassurance that you will be sleeping at night.
And not throwing up.
And not, I mean, I prefer that my clients don't throw up when the market goes down, because what's important to remember, and my job is a lot of education, especially for people who aren't familiar and don't have a long history investing, but to remind clients that volatility and market movements are all part of a normal, healthy, functioning economy. And if you can flip your thinking from volatility as bad to instead think about it as presenting an opportunity and an entry point into different parts of the market, it changes your whole outlook. It's opportunistic investing instead of protecting and managing fear.
It would be weird if there was no volatility, right? That's what markets do. They go up, they go down. It's like a roller coaster. You don't get off in the middle of a roller coaster. But let's talk about how you're thinking about it for the next 5 or 10 years with your clients. What do you think is the optimal risk, depending on risk, of course, optimal mix of equities and fixed income for most folks?
You know, there's no one size fits all, unfortunately. Everything is really customized to a person's risk tolerance, age, wealth management needs, but there are a few consistencies amongst different clients in different risk tolerances. One is that the stock market in the 2010 decade offered 50% greater returns than in any historical time period. Our forward-looking expectation is that stock market returns are going to go back to long-term averages. So instead of expecting the stock market to generate 12 or 13% annualized returns, our expectations are more in the 7 to 8% annualized return range. So in order to capture outsized returns for clients, we have alternative exposure for every client. And the alternative space has developed so nicely so that it's much more accessible to all different types of clients and at all different investment levels. So that's one consistency. The other is to think about your investing on an after-tax basis. So there are a lot of strategies that have come into play recently that allow you to invest in a tax-advantaged way. So if you're a taxable investor, that's another way to have outsized returns that aren't quantified perhaps on your performance report, but will save you capital gains tax dollars when it comes time to April 15th every year.
And also inflation adjusted, of course, because inflation's wild.
Yeah, I mean, absolutely. And inflation is too high and it's been too high for a long time. The Fed is maintaining its goal to lowering inflation, and the long-term target for the Fed is still at 2%. We are far away from that, and we don't expect to hit that 2% target until probably the latter half of next year. But when we build in a target return, we add on top of that target return inflation. So if we're aiming to grow a client's portfolio 5%, our target return is going to be 7% to account for inflation so that the portfolio can maintain its purchasing power.
And your expected returns, you're estimating for equities, it has scooted down. I'm assuming that it's scooted up for bonds right now. I know you like bonds, or clients are investing in a lot of bonds right now. For the first time.
We are tactically overweight bonds today because, like I said, you can get a really nice return to sit on the sidelines and be in a safer asset class and take yourself out of the volatility of the equity game. So tactically, we are overweight fixed income, we are overweight alternatives, and we are underweight equities. You know, if you can earn 4% tax-free in a muni portfolio, that's a return we haven't seen in many years.
What kind of alternatives are you talking about?
So for alternatives, you know, we especially like private equity and private debt. You can do that in many different forms. It depends on the client. It depends on the amount of money that they want to allocate. But you can invest directly in private equity and private debt funds. There are liquid vehicles that also offer clients daily liquidity and still provide exposure to those asset classes. We have maintained an exposure to commodities. That's a good hedge to inflation, and given the environment that we've been in, commodities has been a great play the last 18 months or so.
Which kind of commodities specifically?
We invest in a commodities fund, typically a broad basket of commodities. So we have diversified exposure for our clients. We're not looking to take a single bet necessarily, just to provide broad-based exposure as a general hedge to inflation.
And what about hedge funds or VC funds?
Okay, well, two different. So venture capital is, you know, on the riskier edge of private equity investing. And so we would probably start a client with a more core private equity investment, but VC funds typically are add-ons to building a private equity portfolio. My clients don't have a lot of exposure to hedge funds. We find they're often not transparent, quite expensive, and the vast majority of them are not successful. So we find that we prefer private equity, private debt, and more liquid alternatives in the alternative space.
And real estate?
Sure. Private real estate. A lot of our clients have exposure to private real estate. And then a lot of our clients are real estate investors. And so you've hit on a perfect example of where we customize portfolios for each client. If they don't work or have outside investments in the real estate space, we certainly like direct private real estate investments. although it's a little more difficult now, the mortgage rates are going up. But if you are a real estate investor, that's an example of how we would customize your portfolio and probably not recommend a direct real estate investment, because you would have that exposure outside of your portfolio with my team at Neuberger Berman.
You know what they say about personal finance, it is personal. So, I spend a lot of time, Holly, thinking about the next gen investors, right? It's been reported that a third of investable assets are going to be transferred in the next decade. So this is going to be the biggest transfer of wealth. This is a really big deal in history because boomers made the most money ever. So how should the audience start thinking about this mass wealth transfer that's about to happen?
Hopefully the boomers have started thinking about it for the next gen and started educating them and involving them. A lot of our boomer clients, we encourage them to engage their children perhaps in their family philanthropy, or it's starting to involve them in conversations around investments. So hopefully some of them have had some exposure to investments. But my best advice to people is to educate yourself. Don't ever invest in something you don't understand. Don't ever invest or take advice from someone who makes you feel insecure or not confident. You are the steward of your wealth, and this is your great gift and your great responsibility to protect and grow it in a way that properly reflects your goals and achieves what you want your money to do for you.
So obviously you're overweight crypto.
No crypto exposure in my book.
It's so interesting that you really underscore, and I appreciate that you should have a special relationship with your financial advisor beyond, just talking about fundamentals and technicals. Why do you think that people believe women advisors are the best long-term investments?
Well, you could probably answer that. Why are women the best of many things that we do? But I think women tend to relate to women. So I think women investors enjoy working with women advisors. I think women feel less intimidated working with women financial advisors, but women tend to be a little bit more thoughtful, a little bit more thorough, a little bit more patient. So from an advisor perspective, they instill confidence in their clients. And from an investor perspective, people tend to feel less threatened by women and can ask questions that they might feel intimidated in a different environment.
Have you found that men don't like taking investment advice from women?
Oh, no. I mean, look, men control the vast majority of wealth in my book of business today. That is changing. I mean, women in general control over 50% of investable assets in this country. But in my book, the vast majority of my clients are men, and they seem totally fine taking my advice.
As they should. As one of the top advisors in the country, what do you think your superpower is? I mean, there are so many wealth managers, financial advisors. How have you risen to the top of the list?
People are often surprised by the answer I'm about to give you, but I think the key secret ingredient to success is forming and maintaining successful relationships, whether those relationships are personal, financial, or philanthropic, and those are often overlapping sectors. I think surrounding yourself with successful people and building successful relationship is a key ingredient and a common thread amongst successful people.
And you have offered your success here in this relationship on this show. So Holly Newman Kroft, thank you so much for being here. Thank you so much for sharing your insights.
Thank you for having me.
So let me show you how you can use Magnifi's AI assistant, which gives individual investors the access to information that was only available to institutional investors before. We talked about bonds specifically in this conversation. So take a look at this. I just type in "show me municipal bonds" into the chat, and here's what we get. We are sorting by muni bond investment rankings. I can then say, compare these investments in the chat, and I see which are performing best recently based on risk and return. Then Magnifi gives me all of this information, and what I want to look at are performance and PE ratios. So I select those parameters here, and Magnifi does the rest. You can see it's sorted by returns and also PE ratios. And then under that, you have confidence scores based on those parameters. Holly also talked about stocks, so I can use Magnifi to say, show me the value of stocks or equities, and I can also compare those investments. Magnifi's AI assistant gives me that information instantly. Such great information today, and most of all, a great way for all of you watching to make better informed investment decisions. For more information on investing with intelligence, please visit us at magnifi.com.